All right. Well, thank you so much for having me, Daniel. Nice to meet all of you virtually. It's a pleasure to be here. I will share my screen now so that we can get started. All right. So I'm Sarah Kurth, your presenter. I manage outreach programs at Denver Community Credit Union, which include financial education, including training staff on how to become financial coaches, as well as our volunteering and giving initiatives as an organization. I've been an accredited financial counselor since 2012 and have presented financial education for over 10 years. And I'm really excited to be working with you over these next 5 sessions. And I really want this to be as helpful as possible. There will be a lot of resources tied to credit. Credit is a topic that honestly we could spend 5 hours on easily on its own. So I just want you to feel empowered to ask questions. If we don't get to everything today, I did add some extra time in the next session for us to cover Q&A and some of the homework items that we'll be going through. So if you're not familiar with what a credit union is, this is a question we get a lot. They are not-for-profit. So we offer not-for-profit banking products, loans, and services. Credit unions are owned by their members who have a say in how the credit union is led and operated. Every member of a credit union is an owner. So it's a democratic financial institution where members vote for the board of directors and have a say on how the credit union is run. And this is essentially how it works. So somebody deposits their money within a credit union. That money is used to make low interest loans to other members. Profits are made from the loans, which are put back into the organization and are returned to members through better rates and fewer fees. All right, and a little more about our credit union. We're a not-for-profit financial institution that has served Metro Denver since 1934. This class is part of our award-winning Clear Money program, which is a financial education program that includes live classes and coaching, as well as some e-learning courses that are available on demand in English or Spanish. Our one-on-one financial coaching is currently available via Zoom or phone to answer people's personal finance questions and help them reach their savings, budgeting, credit, and other goals. They're confidential and they can be requested online. And if anyone in the community is interested, please feel free to share that information with them. I'll share the link at the end, and we just reach out and schedule a time that works well for them. And a little bit more about us. We are local. All of our staff volunteer together once a year. We provided 286 financial coaching sessions in branches last year. And we had over 1,200 people attend our in-person classes in 2019, which is really strange to say because everything has shifted online. So we've been doing quite a bit of virtual financial education, but nothing in person as of early March. Okay, so what I would like you to do now is think about the first word that comes to mind when you think of the word credit or a credit score. And feel free to put that in the chat box. And if you're not able to type into the chat box right now, that's totally fine. Just think about what that word may be. And there's no right or wrong answer. So some answers I commonly hear are debt or freedom in some cases to have access to employment, housing, many different things. So credit can really elicit different responses and feelings in different people. So it's really important to recognize that. And a lot of how we feel about credit is based on our background with it, the experiences that we've had with it. And for me, I have had not so great credit in the past and learned from many of my mistakes. was in between jobs during the 2008 recession, which definitely impacted my credit. There were not nearly as many programs at the time to help people with payment deferments and getting assistance at that time. So there's been a lot of credit card reform and lending reform to help with that kind of thing. Okay, so now what we're going to do is we're going to discuss different people's credit situations so that you can get familiar with credit terminology and vocabulary. So Brad is the first person we're going to talk about. He has 0 trade lines, also known as lines of trade. They are open and active loans, credit accounts, or lines of credit, and they are regularly reported to a credit bureau. So what that means is that he currently does not have any open loans that he's making regular payments to. It could be that he has paid off all of his loans and credit cards and closed all of them. It could be that he's never used credit, or it could be that Brad has not used credit or had an open credit line in over 10 years. It would appear as though he's never used credit before on a credit report. And there are 2 types of loans or trade lines. Revolving loans are credit cards and other lines of credit. The way those work is you're given a fixed amount that is your limit, and you can spend up to that limit as you would like until you hit it, right? So if you hit it, there may be some fees. If you go over it, there may be some fees, but you don't have to apply for credit every time you want to use your credit card or line of credit. It's an open revolving line. Installment loans, on the other hand, are a lump sum, typically, and they're paid in installments over a specified term. The term means the amount of time that you have to pay off that loan. The term is usually mentioned in terms of months, but a lot of us think of it as years. So you might have a 24-month term, that's just a 2-year loan. That's just banking speak. And he's had 2 inquiries in the last 6 months. So there are 2 different types of inquiries. And these are really important to note because a very common thing I hear from people is, well, I don't want to pull my credit report. I don't want to check on it because I'm concerned it's going to hurt my credit. Pulling your own credit score for your education to make sure everything on there is accurate and just to educate yourself on where you stand with your credit never negatively impacts you. And because it's considered a soft inquiry and it does not impact credit scores. So as I mentioned, you're never penalized for pulling your own credit information. And you can receive offers in the mail that you didn't ask for. Many of you have probably had that situation. They're called pre-screened offers. So companies pay credit bureaus. Credit bureaus are the organizations that maintain credit reports. There are 3 of them in the United States. And we will get into that a little later. But companies such as car dealerships, banks, credit unions will pay to send offers to specific customers who meet a certain profile. Somebody who's had a car loan for 3 years might be sent something to refinance their car loan because the guess is that they're ready to refinance at that point or to buy a new vehicle. So if you receive those offers in the mail, it's because companies have access to your credit report that you did not give permission to necessarily to do that. So you are able to opt out of pre-screened offers. And we will look at that link a little later. But I highly recommend that. That reduces the likelihood of identity theft, and the fewer places where your social security number and information is floating around, the better. The other type of inquiry, or a hit on your credit report, is a hard inquiry, and that does impact your credit scores. So that would be pretty much every time that you apply for a credit card. So if you apply for 10 credit cards in 1 month, it will drop your credit score 10 times, which is not obvious, right? I have made that mistake because I just wanted to get the best rate and see what I would qualify for. So whether I am approved for 10 credit cards or turned down for 10, it's going to knock my score down a little bit each time. It's usually 3 to 5 points. And those hard inquiries, whenever you apply for loans, stay on your credit report for 2 years. They don't keep your score down for 2 years. but they appear there for 2 years. And part of the reason that you can see those on your credit report is because you want to be able to tell if somebody's applying for credit and it's not you. There are some exceptions for auto loans and mortgages. So with those loans, you have at least 14 business days where you can shop around with different lenders to compare rates, and your score will only drop once about 30 days later. And that's worth noting too with hard inquiries. So if you apply for a loan, it's not like your score drops right then a few points and you're suddenly being given an interest rate that's higher than it would have otherwise been. It takes about 30 days to go through the system, at least 30 days, depending on when the information is reported to credit bureaus. And it does not impact the rate that you're offered. And in fact, many credit unions and banks will keep your credit score on file for a specific amount of time. So it might be 90 days, it might be 120 days. So if I applied for a credit card at my credit union, and within 90 days I applied for a car loan, they're not going to pull my credit score a second time. They'll use the one they have on file. Some other important things to note about inquiries is that it can happen when any financial institution or company checks your credit. So it can happen with utilities. It can happen with employment and seeking housing. So if a landlord is checking your credit, that is a soft inquiry. And same with employment and background checks. Those never drop your credit score, but they will all appear on your credit report so that you know which companies have pulled your credit. And with utility companies, they have to ask you permission to pull your credit report. So cell phone, water, electric, and they are supposed to be a soft inquiry. Sometimes they're not. I had that experience where I moved and CenturyLink at the time pulled my credit and it nicked my score. And I called them and I said, hey, this wasn't supposed to be a hard inquiry. I was in the process of applying for a loan at the time. And because they hadn't disclosed that that would be the case, they had to remove it from my credit report. So always ask that question. Not everyone will know what that means. Every customer service representative you speak with might not be really knowledgeable about credit, who works at a utility company, for example. But you'll want to ask that question. And same with shopping for insurance. Shopping for insurance to make sure that you're getting the best rate you can should not hurt your score, but I have seen it be a hard hit. So some of those are a little bit of gray areas. And if you're in the process of applying for a mortgage to buy your home and you want your score to be as high as possible, those are just things to be mindful of. Okay, Greg is the next person, and Greg has some unpaid collection accounts. So collection accounts are debts that are owed to lenders and are typically sold. So it would be like if I had a cell phone contract with Sprint and I stopped paying it, they would continue to try to collect it from me for a while, and then they would sell it to another company to collect it. And so then I wouldn't be working with Sprint anymore. I would be working with another company. The problem there is, even though Sprint is not going to report that I'm making cell phone payments on time, as soon as I start paying them late, they have the power to hurt my credit, even though they've never helped my credit for all of the on-time payments that I had before, let's say, I experienced a job layoff or some other hardship. And then the collection account creates a new account on a credit report that can stay on your report for up to 7 years and 180 days. Most companies will send things to collection after 180 days, but it really varies by company. And as I mentioned, it does display as a negative item. So ideally, it's always best to work out a payment plan and communicate with the original lender or company that you have regular ongoing bills with before it gets to collection and does more damage. Another really important thing to note is that the amount does not matter. I have seen $25 parking fines, and they hurt a credit report and score just as much as a $2,500 medical bill, for example. And medical bills in particular, or unpaid lawyer fees, that kind of thing, typically you can pay off on a payment plan at 0% interest, particularly with a hospital, ER bills, unexpected things like that. So it's really best to work those out directly with the company than have them end up in collections. And on that note, with medical billing, you really want to be careful that you are paying back what you actually owe. Medical billing errors are very, very common. I've experienced this where I've received a bill for something I know was covered and I didn't owe. And if I just ignored the bill, it would have eventually gone to collections, but it took, I think, 6 phone calls to Kaiser Permanente, which was not how I wanted to spend my time on my lunch breaks, to get it fixed. And it was a $70 bill. I could have paid it, but I did not want to because I did not owe it. But again, it was my responsibility to have to take all those extra steps and dispute it and talk to a manager and continue to follow up until they got the billing corrected. So if you're unsure whether you owe a bill or not, or you're seeing a collection account that may not belong to you, could be identity theft, it could be an error. So don't pay a bill that you don't recognize and know for sure that you owe. Do a little digging and research to make sure that you owe it or provide proof that you've already paid it. But do that so that it doesn't damage your report and score. And paying off a collection account significantly improves a credit score. So I've had a collection account in the past, and when it went from having a balance to being paid to 0, my score shot up 60 points, 60, which made a huge difference in my score. So they really can have a big impact. It really varies on how many on-time payments you have on your report and how many collections and how many accounts in general. So 60 is not the same thing for everyone. But again, regardless of the dollar amount, something you want to be really mindful of is sometimes a collection agency will say, okay, you owe us $2,500, but if you pay us $1,000, we'll call it even. You want to be careful with that because it's considered settling for less than you owe, and it puts a flag on your credit report. And there are some lenders, particularly mortgage lenders, so loans to buy a home, that will not loan to anybody who has that on their credit report. So if you're considering buying a home, be very careful. Unfortunately, collectors do not usually tell you that. And collectors can be quite aggressive and pushy and make their debt that they're trying to collect the number one priority, but you really have to focus on what's going on and what is most important to you, right? So like rent, keeping a roof over your head, feeding yourself and your family will probably take precedent over a large medical bill that you're working on paying off as best as you can. So continuing that communication is really important, but you'd want to take notes. And if you pay anything, keep really good records. And, a good practice is to just make sure that you keep your address up to date with companies. I've seen that example with the $25 parking ticket with somebody I worked with. That was just a matter of their address not being updated with the DMV. They got one of those speeding tickets from a parked van that caught them, and it went to their old address, and then it ended up in collections and damaged their credit. Same with, library fines and many other things. If you go to USPS's website, the US Postal Service, it costs $1 and they will forward your mail for 6 months, and there'll be a little yellow label on there that shows you that your address isn't up to date with the company, and then that alerts you to other companies you may not have updated your address with. And now going into Greg's credit history. So he has a credit history of 72 months. In general, to have credit, you need to have at least one open credit account that's reporting to credit bureaus for at least 6 months to have enough information to generate a credit score. So if I don't have any credit right now and I've been making on-time payments for 2 months, I don't have a credit score. After 6 months, I should. And typically, the longer you have positive credit history, the better, because it provides more data and to lenders about a borrower, and they can better predict somebody's behavior of borrowing and paying back money on time. So they probably don't have a lot of data on Greg. And where this is really important is if you have, let's say you have, a handful of credit cards, you're like, I really don't want to keep all these cards anymore. Considering keeping the older ones open, as long as they don't have really high annual fees or interest rates, or you just don't want the temptation of getting back into credit card debt if you've paid off your debt, that's worth considering. So longer credit accounts help you more as long as the information is positive, meaning you've made positive on-time payments on there. But I would never encourage you to just drag out your debt, like keep refinancing the same loan over and over and over, or take longer to repay a loan than you need to continue to build your credit history. There are more affordable ways to build credit history, which we'll discuss a little later. Another really important point is that you do not have to carry credit card debt every month to build credit history. You can keep a credit card active and build your credit by charging a small amount for something you need and know you can afford to pay back in full when you get the bill the following month. There's no negative impact for paying off your credit cards, paying off the full balance every month, as long as you keep them active. Right? So as long as you have something reporting every month, it helps you a lot. I have one credit card that I specifically opened, didn't necessarily, need it for any reason other than I wanted to get my credit score as high as possible to prepare for applying for a home loan. And about a year before I knew I was ready, I did that. And that card just sits in a drawer at my home. It has my Netflix account charged to it every month and then paid off automatically every month. And it has helped my credit quite a bit, because before that I only had 2 lines of credit, which is considered not a lot of different credit. And it's hard to build a high score when you don't have a lot of different trade lines or lines of trade going at the same time, especially installment loans. For some reason, an on-time payment to an installment loan, like a car loan, student loan, personal loan, mortgage, helps your credit score more than an on-time payment to a revolving loan, which is a credit card or a line of credit. And that is, I don't know why that is the case, but they both help you when you pay them on time, and they both hurt your score and your report if they are paid late. But again, dragging out an installment loan debt over a long period of time doesn't make sense. So really an affordable way to do that is to have a low cost credit card that has no annual fee or a very low one, putting small expenses on it every month, paying them off in full every month for things you need and can afford. That helped me a ton to rebuild my credit. And I don't have any installment loans currently, and I have a very high credit score. So you do not have to take out debt just to build a credit score. I think that there's a lot of communication around that. I've had many people that I've presented to, including teachers at schools, tell me, oh, well, my banker told me that I needed to keep at least $200 every month balance and pay interest on it to build good credit. And you do not. That is something that, maybe it was somebody misunderstood who worked at the bank, or they were just trying to make money off of their customer and interest, but that is absolutely not true. And it's important to know that, this credit history that Greg has, anything that he has that he pays off will stay on a credit report for 10 years, as long as it's positive. If he has a car loan isn't the best example, because typically a car loan is up to 5 years, not 10. So let's say he had a student loan and he paid it off over 10 years, it would stay on there and help him for 10 years. If he missed a late payment, it would drop off of his credit report after 7 years, because that net late payment would negatively impact his score and keep it down. If Greg happened to have a credit card, which we know he doesn't, because his length of credit history is 72 months. He opened a credit card 30 years ago and it was still active, the length of his credit history would be 30 years. So I'm just giving you some background on how credit history works, because I find that to be rather confusing. So it's not necessarily the first time you opened a credit card, but it's the oldest active account that's still on your credit report is considered your credit history. Helen is the next person. And Helen has 39 trade lines and 24 paid accounts. So maybe she is a business owner and she has a lot of equipment loans for her restaurant or whatever business she runs. She's current on her accounts, meaning her bills, all of them are up to date, paid on time. She has over $10,000 in credit card balances, and her total available limit is nearly $70,000. So she's using over $10,000 of a limit of nearly $70,000. She has no delinquent accounts. I did not understand what this meant, how this was different from late until I worked at the credit union. A delinquent account is just banking speak for a account that is more than 30 days late. And the reason that's a distinction is that most financial institutions, credit unions, and banks do not report a loan as late unless it's been paid more than 30 days late. They will charge a fee before then, a late fee, but they do not typically report to credit bureaus. Other lenders and companies, it varies quite a bit. I did financial coaching with a gentleman who was late on his car loan to a dealership, and they repossessed his car within 2 days of it being late, which was in the fine print. So not only did it get reported as late, it got repossessed, which added a ton of fees and made it even harder for him to pay it back and recover his car. So you want to be really careful about where you get your loans from and really understand, all that fine print and fees that could come up. And she has no late payments. So as I mentioned, a late payment can stay on a credit report for up to 7 years, and typically they're reported 30 days or more late. Helen's length of credit history in this example is 191 months, which is almost 16 years. And her credit utilization, which is what percentage of the limit on her credit card she's using relative to the limit, is about 15%. And the reason I'm mentioning that is we will discuss that as a factor for credit score later. And what I want you to keep in mind so far is which of these people you think is going to have the highest credit score. Okay, moving on to the next person. We have Sarah. She's our last person in this example. Sarah filed bankruptcy in 2015. Bankruptcy is, I think, oftentimes a misunderstood process. It's usually a last resort. So usually people work out a debt management plan through a nonprofit credit counseling agencies. Bankruptcy does usually have some costs associated with it, and there are two different kinds. So most people who file for bankruptcy actually have to repay most of their debt through what's called a Chapter 13 that stays on a credit report for 7 years. Chapter 7 bankruptcy is where most of the debt is wiped out. It's a lot less common. It does stay on a credit report for 10 years. And typically people who qualify for that have to be able to demonstrate that they are not going to be able to earn income ever again to repay those debts. So it could be that I was working and became totally disabled to the point where I'm unable to work and earn income, then I might qualify. But otherwise, it's pretty rare. So most people who file bankruptcy, it's kind of just restructuring their debt, and they have a debt payment to repay. Sarah's had 9 inquiries in the last 6 months, so she's applied for 9 different loans. She has maxed out her credit cards, meaning that she has gotten close to the limit. When I was first learning and was first issued credit cards when I was 18, I had a limit, and I was like, well, what's the problem with hitting, going up to the limit? If I have a limit, what's the problem? And unfortunately, that can really damage a credit score, getting close to that limit or hitting the limit, which is maxing out. And what it refers to is that credit utilization, the percentage of the limit used on a revolving loan. And she has not missed any payments since bankruptcy. So please keep these 4 people in mind as we go through the next few slides, and we'll discuss who has the best score. Okay, so now I want you to think about which of these 2 is the best definition of credit. Is it A, a number that lenders use to determine whether to give you a loan or not? Or is it B, confidence in a borrower's ability and intention to repay? Okay, if you guessed B, you are correct. Credit is a more general concept, whereas A is the definition of a credit score. And people tend to be really concerned about the score, but a credit score is only based off of what's in a report and can fluctuate day to day. And so it's really important to know what's in a credit report, right? Because your score is only based off of what's in a credit report. So here are some of the things that are included. personal identification information. So your name, social security number, birth date, address, phone numbers associated with you, loan account information, your open accounts, accounts that have been closed in the past 7 to 10 years, which are loans. You won't see savings or checking accounts there. The dates that the accounts were open and closed, your payment history on those loans, your credit utilization, meaning the percentage that you've used on your credit cards and lines of credit, the balances on your accounts, your loan payment status for each loan, meaning whether it's on time, late, how late. There are also some public records, so bankruptcies, foreclosures, tax liens, civil judgments. Some of those are, a judgment is when you go to court and a judge orders money to be taken out of your paycheck or account. It can be a variety of different things. It also includes inquiries, so the soft ones as well as the hard ones. And we discussed what those look like, but it's important to know that those are there so that if there's a company you don't recognize pulling your credit report, or it says you applied for a loan that you didn't, that's a big red flag that somebody applied for a loan under your social security number. Things that are not included are just as important to note. Your income is not included, your race, your employment status. Some things are included, but not part of your score. So your date of birth is there. They can tell your age, but that is completely different than the length of your credit history, which is something that impacts your credit score. They can see your address, but that has no factor, your zip code, on your credit score. It's also important to understand that credit bureaus are separate companies and that they are for-profit companies. Their job is to make money, and a lot of it. There are 3 credit bureaus: Experian, TransUnion, and Equifax. Experian and TransUnion are the most commonly used in Colorado because they are based on this side of the country, whereas Equifax is on the East Coast. And it's really good to know what is in each of those credit reports because you don't know which company your lender or the car dealership you got a loan through or any organization that reports to your credit bureau reports to. Companies by law are not required to report your on-time payments, which is a little unfair. I understand they're businesses and it costs money to report to the credit bureaus, but you could get a loan at a car dealership and pay every single payment on time for 5 years. It may not help your credit score at all if they don't report to the credit bureau your on-time payments. And they can choose to report only your late payments, but not your on-time payments. And companies that never report on-time payments, such as my landlord, I always pay my rent on time. I get nothing out of it on my credit report that helps me. However, if I were to stop paying my rent, it would show up on my credit report. Same with my cell phone bill, my utilities, my electric, all of that. So companies have the power to harm your score and not help it. And that's why many people might have no trade lines on their report and just collection accounts, right? Because they're only the negative information is being demonstrated on there, even though they might save up and pay for cash with everything and be very responsible with how they manage their money. There might be, one traffic ticket that was sent to their old address and causes them to have a really low score because they have nothing reporting on time regular payments every month. And I also want to note that with credit bureaus, some companies will report to all 3, some will pick 1 or 2. For mortgages, typically lenders look at all 3 credit agencies. And they don't pick your highest score or your lowest score from the 3, they pick the one in the middle, which is interesting. And if you're applying with another person, like a partner or a family member or a business partner for an investment property or something like that, they pick the middle one for both of you, and then of those, they pick the lowest. They don't take an average of your credit scores. So it's important to know what's on all of those reports. And mistakes are very common on credit reports, I should add, so it's really important to keep an eye on them, and that'll be part of the homework, is pulling your credit reports and looking at it to see if things are accurate. And just a reminder, credit scores are only based off of what's in your credit report. So it's more important, a credit report, in my opinion, than the score. The score is helpful to know where you stand, but it depends on where you get the score. Some of the scores are nothing like what a lender uses, like Credit Karma provides scores, but they're not the scores that a lender uses. And we'll talk a little later about where you can get a free credit score that is similar to what a lender uses. Here's an example of those main pieces of information that pop up on a credit report. In the resources that you will be sent, you'll find a sample credit report that's a printed one as well as a digital one. This isn't exactly what one would look like, but fits well on a screen, better than really small font that I can't fit well into a PowerPoint. So it has that personal identification information at the top, your public records. This person has a collection account for $500. You can see their trade lines, so their auto loans, the date it was opened, the highest amount that they've borrowed or balance that they've had, and their current balance. And if the status says current, it means it's up to date and on time. And you can see the inquiries. There was a cell phone provider that pulled their credit and a card issuer. All right. So as I mentioned, mistakes are common. I highly encourage you to go to annualcreditreport.com to get free credit reports every 12 months. Due to the pandemic, you can actually pull your reports from each of the bureaus weekly, now through April of next year. And it allows you to dispute errors, inaccurate information, and have it removed for free. You do not have to pay anyone to help you with this. Of course, if you want guidance and want to do financial coaching, we'd be happy to walk you through it. But I see a lot of commercials and hear people that are paying money to a company to help with their credit. As long as you're disputing information that is incorrect, there is no reason you need to pay someone. And in fact, some companies will encourage people to dispute to have things removed from their credit reports that are accurate. And that can actually backfire because the credit bureaus will then mark potential fraud on your account, on your reports, and it makes it harder to dispute things in the future. Other things to keep in mind are that this website is free. It will not ask you for credit card information. It's set up through the federal government, which is tied to a law that allows you access to your credit reports. Even outside of the pandemic, if you were to be unemployed and looking for work, or you're receiving public benefits, or you suspect identity theft, or you've been a victim of identity theft, or there's anything wrong on your report, you can pull your reports more than once a year. So there are many, many reasons to do it. And what's the difference between a credit report, and a credit score? I touched on this a little bit. Credit impacts many aspects of our lives in addition to borrowing, such as access to housing, utilities, affordable loans, education, business loans, as well as personal loans. And as I mentioned, credit is the more general concept. The report is the data, right? So it has all of that information about you, which is why it's important to know whether it's accurate or not. And a credit score is really a snapshot in time. So it's based on which credit bureau used it, what kind of scoring model they use. There are many, many different scoring models. We're going to go over the most commonly used one that's used in 90% of lending decisions. But it's good to understand the difference between them. Okay. So now we're going to go over some items, and I want you to think about or type into the chat whether they are credit score is or is not important. So a checking account. Do you think a checking account, your credit score matters for it? It could go either way. This was a little of a trick question. So some banks and credit unions will pull a credit score to give you a checking account or not. Our Denver community where I work does not do that. It is not a loan, and really there's no reason to do that. The reason a lot of places do is it's kind of a way to discriminate or really narrow down your customer base. So most financial institutions make money off of interest on loans. They don't make money by giving you interest on your savings in a savings account or the money you put into a checking account. So they pull credit because if you qualify for loans, then they can earn more money off of you. We fundamentally don't believe in that. We only pull credit scores and credit for the purpose of extending a loan that somebody requested. And it can also drop your score, right? So if I go and open a savings account at a bank or a credit union where they pulled my score, it's going to be a hard inquiry and it'll drop my score a little bit. So it's important to know that that's the case and just ask the question. Not everybody does, but most financial institutions do pull that for checking account. Getting a job is another one that is a gray area. So some employers will pull it, some will not. The Colorado State Legislature a few years back passed a law saying that an applicant for a job cannot be discriminated against based on their credit or credit score unless they are in a position where they are handling money, managing the money. That's really important to know as well. A rent-to-own store, do you think credit is important or not? I have heard that go either way, and we'll talk about some others in the meantime. So renting an apartment or a home, score is definitely important. Most places will pull a credit score for that. A payday loan, your score is not important. An auto loan, your score is important. That will determine the cost of you borrowing. A pawn shop, your score is not important. A pawn shop is kind of like a secured loan. If I take my laptop to a pawn shop, they're going to give me money for the laptop. If I do not pay back that money, then they will keep my laptop, which is collateral, something that secures the loan and gives them comfort in loaning me money, knowing they have something of mine. Other examples of secured loans would be a mortgage. If I don't pay my home loan back, I could lose my home. If I don't pay my car loan back, which is another secured loan, then I would have my car repossessed and potentially lose it. A mortgage, as you probably can guess, it's definitely important. Probably the most expensive loan anyone will ever take out is a mortgage or home loan. And then the last one is, do you think auto insurance is or is not important? It is. So it is a factor. The higher the credit score, the lower your rate will be, but it also depends on your driving record. So I could have fantastic credit, but if I get a speeding ticket every other week, I'm going to pay very, very high rates on my auto insurance. Other factors include age, gender, and a couple other factors. Okay, so getting to that FICO credit score. So FICO is the score that's used by 90% of lenders, and the higher the score, the better. It ranges from 300 to 850, and again, it's based only on information in your credit report. You have 3 different FICO scores, one for each credit bureau, based off the information in that bureau's report. And just some fun facts, fun to me. I'm a geek when it comes to this kind of stuff. The average FICO score in Colorado as of last year is 718, which is the 13th highest in the nation. And the Midwestern states, for some reason, have the highest. And it's gone up substantially over the years. And your FICO credit score is based off of 5 categories, which we'll get to shortly. And you can get a free FICO score on the Experian app. I highly recommend that. That'll be part of the homework. And it's an app you can get for a smartphone, or you can go to the website, and I'll show you the link here shortly. You don't have to enter your credit card information. As I mentioned, credit bureaus are for-profit companies, so if they ever ask you for a credit card, that's a red flag that you're signing up for a trial and you'll be charged for something later. I've made that mistake in the past, canceled within the trial frame and still kept getting billed. So really, it's a good practice with any company. If you're trying something for free, not to provide your credit card, because you could get trapped, your credit or debit card. Credit Karma and other companies that offer free credit scores typically do not offer FICO scores. Those scores are lower cost and not used in lending decisions. They're usually used for those pre-approvals that I mentioned. So those letters that you might get that say, oh, you're pre-approved for a credit card or a car loan or a personal loan, a soft inquiry. And all those companies, that soft inquiry offer that they send you doesn't hurt your credit score, but when you send it back or you go to the website and you sign up to request that credit card or loan, then they pull a FICO score, which is a hard inquiry and does hit your score about 30 days later. Okay, so we're going to look at the factors that determine a FICO score. And I want you to try to guess which of these are the two most important. So which one of these 5 factors is 35%, the most weighted, the most important, and which is 30%, the second most important? Okay, this actually really surprised me when I first started becoming a financial educator. Payment history is the most important thing. So it's not the limit on your credit cards or how many loans you have, it's paying on time. That's the number one thing. Things that this takes into account is when was the most recent delinquency, late payment, collection, how severe was it? So if I made a late payment, 30-day late payment is not going to hurt me as much as a 90-day late payment. How many of my items were late? And as I mentioned, on-time payment to installment loans help more than revolving loans. And building credit can take a lot longer if you only have one credit account, which I did for a very long time. And my score was in the 700s, which is pretty good. But I added a couple more. I staggered them over time so that I wouldn't hurt the average length of my credit history or the amount of new credit I was adding at once, which are some factors we'll discuss shortly. And, there are ways to build credit without actually taking out any debt or installment loans. Can you guess the second most important? It's credit utilization. So credit utilization, as I mentioned, is what percentage of the limit on your credit cards and lines of credit are you using? And the lower, the better, always. It's sometimes this is called outstanding debt. Like even if you go to FICO website, it'll say, oh, it's your outstanding debt, which is very misleading. No one expects you to get a car loan and suddenly pay it way down, or a student loan, or a mortgage, or a personal loan. This only looks at what percentage of the limit you're using on those revolving loans. The lower, the better, always. And you want to use it, as I mentioned, keep the card active. If I have a credit card or line of credit and I didn't put anything on it, I didn't charge anything to it in a month, I'm not going to get reported as making an on-time payment because I didn't owe a payment. But if I put a penny on there, a dollar on there, and repay it, that will help. And typically, if you have a good credit, a high score, you're happy with your score, you can keep it up to 30% of the limit. But if you want your score to be as high as possible, only up to 10%. And that can make a huge difference. So as I was preparing to apply for a mortgage, and the market is crazy and everything is really expensive and unaffordable, so I'm not there yet. I went from putting up to 30% of the limit on my cards that I was paying off in full for groceries, regular bills I had, to keeping it to 10%. And over the course of 6 months of doing that, my score went up 80 points. So it made a huge difference. My score was already good. It was in the 700s, but it went up into the 800s, and that was the only change I made. So it might sound really petty, like what's the difference between, 27% and 17% and 7%, but it actually makes quite a bit of difference. And that's why being maxed out or so close to the limit really hurts a credit score. I still think it's misleading that lenders give credit cards to people and don't ever explain that concept to them, because I learned that the hard way. I was like, well, this is my limit. And when I was first starting off, my limit was really low, right? Like a $300 limit. So I was going up to 300 and then paying it off the next month. So if you have a lower card limit, you want to just put really small expenses on there or constantly pay down your card. And you can do that. Like if you have a card where you're like, oh, I want to get cash back, or I want to get miles, or I have this, I'm booking a hotel and I need to use a credit card, they don't accept debit cards. You can do that, but just pay that off right away, so it does not get close to that limit. The length of credit history is 15%. So these next three we're discussing are important, but they are all half as important as the top ones. Combined, they certainly add up. But if you can't focus on all five things, which most people can at the exact same time, focus on the first two and then shift your focus to these. So credit history, again, is how long you've had accounts established, the average number of months that they've been open. And it also includes new accounts, right? So if I open a new account this month, it's going to lower my average credit history. If the last time I opened a line of credit was 10 years, it would average out 10 years with 1 month, which would lower it. The amount of new credit is 10%. So those are those inquiries. And again, those inquiries, they stay on a credit report for 2 years, but they impact your score for 12 months. FICO only considers those for the 12 months. The different scoring models are a little different, but that's for FICO. And again, your score will not be impacted by promotional offers you didn't ask for, account reviews. So you might have a bank or a credit union account and you see that every month or once a quarter, they pull your credit. If they're doing that because they're just reviewing your account to see how you're doing, to see if they want to offer you different loans or a higher limit on your credit card and so forth, or just to look at what you're doing and see if you have an auto loan somewhere else and they can try to get it at their financial institution, that does not hurt you because you didn't ask for that. Same with employment, background checks, checks if you're applying for a rental and that's pulled as part of a background check. And the types of credit in use is the last 10%. So it's best to have a mix of installment and revolving loans, but you don't have to. I have a high score that's in the 800s. It's not as high as it would be if I had an installment loan, but I'm certainly not going to take out debt I don't need to build it because I know of other ways to build it affordably. Okay, so thinking back to those 4 people, who do you think had the highest credit score? If you guessed Helen, you are correct. And remember, Helen had 10,000 some dollars in credit card balances that she was carrying month to month, but her limit was 70,000. So her credit utilization was 15%. Credit is very important. It's a good financial skill, but managing your money is important too. So if one of your goals is not to pay interest and finance charges on loans that could be really high on a credit card, maybe you manage your money differently than Helen. Credit is an important tool in your money management toolbox, but not the only tool. You want to manage money in a way that helps you reach your financial goals and aligns with your values. Now we'll look at a quick example of the dollar impact of a credit score. So these are not our rates, they're just an example. Rates are actually lower than this, but you can see that they're tiered. So depending on what tier your credit is, what range determines your credit, your APR, your annual percentage rate, which is the interest rate you pay over the course of a year. The higher the score, the lower the rate. So 2 people get a $10,000 5-year auto loan, and you can see the difference per month and the difference they pay in interest over 5 years. And it's a pretty big difference. The monthly might not seem like a big difference. It is to me, but it's about $65, so a little over that. But look at the difference they pay in interest over 5 years. It's almost $4,000. I'm sure we can all think of something we would rather spend $4,000 on than give it to our financial institution. Okay, so now what I want you to think about is, can you have a good credit score if you don't use credit? I probably already gave this away. The answer is no. Someone who does not use credit would have no credit score. You have to have regularly reported on-time payments to build it. And it takes 6 months, as I mentioned, to build a credit score. can be considered risky if there's no data on you. So I personally really like to save up for things and pay them off right away and not take out loans for them. But that I'm considered risky for doing that if I'm not using any credit to prove that I'm able to borrow money and pay it back. So the credit system certainly has its faults, in my opinion, and it's not equitable or necessarily fair. But it's a way that lenders calculate risk, and that is how the system is set up. And so this is an example from FICO. So this will be in your handout so you can look over it, but you'll see, different people's credit utilization definitely impacts their score, right? The person with the lowest credit utilization has the highest score, even though she doesn't have as long of a credit history as Rachel. So Maria has the highest score in this case. So I think this is an interesting example that shows you that it's not the amount of debt you have, it's really credit utilization and on-time payments. And it'll show you exactly how a score will drop based on different things. If a late payment is missed, by how long it's late, if somebody takes out a new loan, or they max out their credit card. So this is fascinating and worth digging into a little later. In the interest of time, I'm going to keep going, but this will be in your resource handouts. So building or rebuilding credit affordably. For the highest score possible, as I mentioned, you keep those revolving loans up to 10% at all times. You can set alerts. So for me, if my credit card hits a certain dollar amount, I get a text message and an email about it. You can even do that with things that are not loans to keep you on track. Checking accounts, savings accounts, if it drops below a certain amount. Pay your credit card balances in full every month to avoid paying interest. That does not necessarily help your score, but I do recommend it so that you can hold on to more of your money from a financial management standpoint. And there are different tools that you can use, and we'll talk about these in the next class. So there are secured credit cards, credit builder loans, credit cards with low or no annual fees. $25 a year, for example, is a reasonable amount to pay for a credit card annual fee. And I give you that because I worked with a young woman who was building her credit for the first time, got a secured credit card, meaning she put $200 of her savings in the bank. They gave her a credit card for a $200 limit. It's secured with her own money because she had no credit and was building it for the first time. Her annual fee was $129 a year, which is so high, right? So some credit cards have really high annual fees, but have like crazy perks and are designed for, world business travelers and people who get a lot of use out of it. For what that card was giving her, it was not worth it. So that's why I give you that example. And I want to make sure we have some time for questions. So I am going to move forward and cover some of this in the next class, which I had anticipated in the interest of time. Like I said, I could go on and on about credit. So next time I'll talk about credit builder loans, secured cards, other credit cards, questions to ask. But in the interest of time, I'll move forward so we have a little time for questions. I think we started about 5:35. So strategies for good credit, just to recap, check your credit report at least once a year for free. Pay your bills on time, pay off collection accounts. That's a way to boost a score quickly. Keep the amounts owed low, so 10% or less for the highest score, up to 30% to maintain good credit. Keep your history as long as possible within reason. You don't want to drag out or keep a credit card that has really high fees or just a company you don't want to do business with anymore, but take that into consideration. What happens if you do close it? Keep your inquiries to the necessary. So it can be tempting, for example, around the holidays to apply for a store credit card at every store that offers a discount for opening one. But I've done that, actually. I'm a bargain hunter. I love a good deal and a sale. But that hurt my credit. And if you have a card that you can only use at a specific store, unless there are things you need from that store every month, they're really hard to keep active. So Could I find something to buy at Best Buy every month? Yeah. Do I have any business doing that? No. Like a Target or Walmart gift card, if I get prescriptions there every month, could make sense. But those credit card interest rates are really, really high, typically over 20% on average. We'll discuss that a little more next time, but worth keeping in mind. And having a mix of credit is also quite helpful. If you're in trouble, decide to take control. Deciding to do something about your credit, even looking at it, can be a hard first step. I know, because I've been there. I knew it was bad after I was in between jobs in 2008 and unable to pay all of my bills on time. But just taking that step to do something about it, honestly, was the hardest thing to do, just to take that one step forward. Get copies of your 3 credit reports. Call your creditors, lenders, companies you do business with whenever you are experiencing trouble. See programs they can provide. Fix your accredited credit counselor at a nonprofit. So GreenPath is a local company, and I can give you more information about them. Again, they are a nonprofit organization. Be very, very careful about companies managing your debt, and because a lot of them are scams. Tell you all kinds of horror stories and indicate the times that work well for you. And then I'll also send a flyer about coaching and about the e-courses that are available on demand, include credit scores, building savings, all kinds of topics. Now for homework. I want you to note for next time what surprised you most and what were your biggest takeaways about credit or credit scoring. I would like you to pull your credit reports from annualcreditreport.com. Again, it's free. It's a secure website managed by the federal government. You will be asked security questions and your social. So when you're filling out those forms, please do not use a public Wi-Fi network. Use a private one that's password protected, and no one has the information other than you, so your information doesn't leak out there. And then try out the Experian app if you have a smartphone, or go to this website on Experian to pull a free FICO score so that you go through it. And this really helps you be able to guide other people and train other people on this process and how to do it. Okay, questions. And keep in mind, we will have more time next week to discuss based on your feedback and takeaways and questions that you might have. No questions. Is everyone just stunned because they learned so much? Hi, Brenda.
Hi. I was asking, what about these different people? My son said, oh, they told me they'll give me a repair my credit. And I said, that might be a scam. Is it?
Usually, yes. So whenever I hear the term credit repair or credit fix, or people will say, we'll wipe out your debt, it's usually a scam, or it's a company that's going to charge money for services that can be done by a nonprofit for free, or by you for free, or by your son. So really, there's no way to repair credit that has been damaged due to late payments, collections. The only way to counteract that is to create positive credit history moving forward. So on-time payments, paying off collections, and it takes time. I have been in that boat. I used to not have great credit, and it felt like it took forever, but it really can be done. I worked with a member who filed bankruptcy. He started a business. It didn't work out. He filed bankruptcy, and within like 4 years, he had a score in the high 700s, which is considered very good. Typically, a FICO score of between 720 to 740, you get offered the best lending rates. So it absolutely can be done. A lot of it is just really understanding kind of the rules of credit and how to manage credit well. And like I said, something as simple as a credit builder loan, which I'll talk about the details next time, or a secured credit card are really low cost, affordable ways to build credit without taking on a ton of debt. I hear that a lot where people are like, oh, if you want to improve your credit, you got to go get a big car loan. It's like, no, you don't have to do that. So there are different ways to do it. But to your point, Brenda, usually when someone says they can repair someone's credit, it's a red flag for me.
Well, I wondered if they still had the credit counseling where programs within employment where they would have them go and bring all their bills, and then the counselor would select the ones and how much they would pay, and some of them would be wiped off.
Yes. So there are what are called debt management plans, and those are offered through nonprofits, including the company GreenPath that I mentioned. I will provide a handout that includes GreenPath's information. And they're a local company, and they do exactly what you said. So they will go through, okay, what is all the debt that you have? They help people make a budget, and then they negotiate those payments directly with the companies. What's important to know is that if you enroll in a debt management plan, let's say I have 5 credit cards that the interest rates are very high, can't afford to keep up with them, or I just want to pay them off more quickly, and I enroll them in a debt management plan, I'm required to close all of those accounts. They do also work with collection accounts. They work with medical bills, lawyers' bills, so things that are not credit cards. But if I enroll it in a debt management plan, I have to close it. So I might want to keep one credit card open just to continue building my credit, or transfer some of that debt onto another one and close them. But those can be a wonderful resource. I referred my best friend to a debt management plan a few years ago. So you can imagine, because of what I do, my friends and family all come to me for advice. So I know a lot more about people's financial business than I think I would otherwise. And she ended up, once she enrolled in a debt management plan with a nonprofit, her minimum payments on her credit cards went from being $700 a month to $300 a month. $300 a month is still a lot, but saving $400 a month that she was required to pay is huge. And it's a plan, a debt management plan is a plan to pay off debt in 3 to 5 years. And some of that debt cannot be wiped out. Some of it is forgiven in some cases, but not always. Again, some collectors will try to forgive some debt, and it can actually do more damage to a credit report and score. So I agree, working with a credit counseling agency, as long as it's a nonprofit, not a company that charges, like a monthly fee. Debt management plans do usually have a fee, because even though it's a nonprofit, they have to pay their staff to maintain those accounts, do the negotiating, but it's usually very nominal. In Colorado, it's capped at no more than $50 a month. And it's typically $10 per account. So let's say I enroll 2 accounts in a debt management plan, it would be $20 a month. If I enroll 5, it would be $50. But if I enroll 10 things, the cap is still $50. So that is, initially my thinking was, well, I'd rather just do it myself than work with a company. And it helped my friend a ton. She was willing to pay the $50 a month to enroll all that to save $400 a month in minimum payments. And you're working with someone reputable, and any of you who've ever called companies and tried to negotiate and talk to somebody's manager know kind of the heartache is with that. And they're able to work with credit counseling agencies in a different way than just you or me or even the credit union, because they have those relationships. So they're not a good fit for everyone. Some people choose to make their own debt management plan and go after it. It requires a lot of discipline, sticking to your own budget. The difference with a debt management plan through a nonprofit is it builds in that accountability. So I have a financial counselor I'm checking in with regularly. They're checking on me, making sure I'm staying on track, whereas I might not want to do that or actually do that on my own.
Can I just interrupt real quick? I just want to make sure that these are great questions and great information, and I want to make sure that everyone who's participating in this can have all this information shared with them as well. Sarah did say that there will be Q&A time in next session. It's built in. Today was a lot of information. My brain is kind of full.
It's a lot.
I appreciate it.
in respect of everyone's time, can we call this an end for this meeting? And then we'll meet you back all next week.
All right.
Yeah, that sounds great. And yeah, if you
Sounds
have any
good.
questions, you can always send them to Daniel. He can send them to me and I can be prepared for them. Or if you just want to jot them down so you don't forget them for next week, I'm happy to cover them. I'll set aside plenty of time for questions.
Yeah, great information.
Awesome.
My pleasure. There's so much to credit. Sorry it took so long. I swear I could talk about credit for 5 hours and not get through all of it. All of it's so important.
Thank you all so
Yeah.
much. Have a great evening.
Thank
All
you,
right,
everyone.
good
Take
night.
care.
Thank you. Bye-bye. Thank you.
Bye.